morning, everyone. This is Mortgage Pros 411. I'm Audery Boisno with Kevin Casey, and today we are joined by Mr. Housing Wire, Diego Sanchez. How are you this morning, Diego?
Doing great. It's actually afternoon here in Brooklyn, New York. It's been a good day so far, good week so far, especially if you are operating a business media company that covers housing, because there's never a dull moment.
Never
And
a dull moment. We were just talking about that. What is
Constant news.
crazy is normal? That's our business. That's how it is. Crazy is normal, right?
yeah, it is. I mean, I've been at Housing Wire now for over 7 years, and there has never been a dull moment in those 7 years, to the point where I wouldn't mind, a couple of weeks that were a little bit dull. But the housing market has been pretty wild for 7+ years.
Right. Well, I can tell you that as a 36-year-old, not year old, 36-year veteran of this industry, it's been wild since I've been in it, in one way or another. So, and when it's calm, that means it's slow and we're all like sucking wind and praying for rates to get better and for whatever to get better. And the reality is we just need to focus on what is right in front of us, which there are always people who need a place to live, and move it along. Okay, so just because I always like to talk about what's coming up this week, we actually have things coming up this week. The Fed minutes are going to be released from the last meeting. They might be a little interesting, just considering the comments from Uncle Jerome and the idea that maybe a December price Fed funds decrease is not exactly a given. So we'll be on alert for that. Thursday, we have existing home sales. And are you ready, kids? We have the BLS jobs report. Now, granted, it's for September, but whatever, we'll take it. So the
Well,
government.
you know what, though? So it's so delayed. Maybe it'll be more accurate.
Okay, so interesting, maybe. And
I mean, I think they should just keep it delayed by 1 month going forward, here on.
okay, so Diego, we recently had Ron Hetrick on our show, and he formerly ran BLS's division that produces the job report. And boy,
Wow.
was it an education. We loved it. It was very interesting, and not at all the information that you get from the mainstream media or any media really. So we consider ourselves much more educated. As a matter of fact, I heard a bunch of secondary guys on a podcast the other day, and I'm like, oh my God, they have no idea. They literally have no idea what they're talking about. Anyway,
Yeah.
moving right along.
You know what's interesting about that podcast though was
That you
he
didn't listen.
called
What is interesting about that?
well, he also called what's going on with the AI stocks now.
Oh, Ron did. Yes.
Yes, he did.
Yes. As a matter of fact, he had gone viral on LinkedIn like the Thursday before he was here on Tuesday, and had gotten a zillion hits from all over the world and so many comments. And then boom, it's out there big time, all the AI talk and the that's a whole nother subject. Okay.
Basically, he said that AI is not bringing value to the economy. And so
In terms of productivity.
yes,
Yeah.
that
Well,
it's like the first
not just
big
productivity. It's 4% of GDP at the moment, but it's taking jobs away from the economy, which potentially, once you take a job out of the mix and that person's ability to earn and have money, then now you're impacting GDP in a whole myriad of other ways, it was really interesting to have this conversation before it was what we were hearing from everyone.
I was at a client event for one of our marketing clients, one of Housing Wire's marketing clients. This was probably 4 or 5 weeks ago. And the CEO of this client basically said, as of 4 or 5 weeks ago, we were in the heights of euphoria when it comes to AI. And then he thinks there's going to be the pit of despair, where we've realized that the productivity improvements may not be as fast as were hoped for. And then we saw a bunch of AI related layoffs in October.
Right.
And so it seems like a lot of companies and whether those layoffs were actually related to AI or not, it seems like companies are using AI as an excuse to let go of people. And so maybe we'll go into a pit of despair. Maybe that's the AI bubble bursting. But then, I still believe, and I agree with the CEO who said it is going to be transformative. And but there will be winners and losers, right? And right now, it feels like the equity markets have been betting that everybody's going to win
Right.
from AI. And so, I think we may have to go through some tougher times, and I don't know how long those will be, but we'll come out on the other side, and there will be clear winners, and AI as a technology will transform mortgage and the rest of the economy.
Well, I have a son in AI, and he just graduated from college and is about to start his master's program at UC Berkeley in machine learning. And I keep telling him, focus on revenue. He's working for a startup. I said, always remember to look at where will this company make money eventually. If they can't make money, they're out. It's going to happen. I mean, right now they might be surviving on, VC funds or whatever their startup source was, but at some point they're going to have to make money. If that is not figured out in the beginning, they're going to be toast. So anyway, it's really interesting, really interesting. And I think that in the mortgage space, again, I've been saying this, we've been saying this for years, which is they're not going to replace us because we have literally closed 0 deals, 0 that could be done by pushing a button recently or in the last few years. Everything we touch, and these are borrowers, whether they're highly qualified or not, they might have $5 million in investments, but maybe they don't have the income so that they can buy the $3 million house and keep the one that they are leaving, and they need non-QM, but also maybe they need us to hold their hand. And I'm finding that on every level, where people need to have a resource where they can run ideas, you can reassure them, they like the personal touch. Yes, they get the emails that are auto generated from the system. They love it when we call them, text them, think about them. I literally last week closed a deal where the borrower found out late in the game that somebody had died in the property. It was in the disclosures, they missed it somehow, and they are ill. And it threw them for a loop. And guess what I did with the help of Mr. Casey? I found a Russian Orthodox priest
Yeah.
to come and do a house blessing. I mean, push a button and get that, people. You know what I mean? Like,
So I do think that AI and other technology can replace some origination, right? So if you look at sort of straightforward refinancings, if you look at people who are buying their second home or their third home or a vacation property and already have experience buying their first home, maybe you could see the robots taking on more of that business, right? Maybe not all of it, right? Because there's still hair on a bunch of those deals, right?
Oh, there's hair on all our deals.
If there's hair on any deal, like I just don't see a robot being able to manage that. And then when it comes to first-time home buyers, to Audery, to your point, I just can't imagine a first-time home buyer not wanting to be walked through the process, such a like intense, emotional process to buy your first home. I can't imagine them not wanting to be walked through by an expert on the real estate side, so a real estate agent, a realtor. And on the mortgage side, I can't imagine them not wanting to be walked through, by an LO. It doesn't make sense to me. And maybe we'll all be wrong, and in 15 years, robots are replacing everything. I don't see those high touch type sales interactions being replaced by AI.
well, I think too that there is a lot that is missed when there's an assumption that just because someone's a repeat buyer, they don't need us. So I have a client right now, 800 plus credit score, owns their primary residence free and clear, their rental property free and clear, and they have a second home they bought that their LTV on it is probably 30 something percent. They're going to refinance to get a lower rate on that second home we did. And again, this is like an engineer, super bright, so on top of it, financially has got everything going for them. And I said, what if we lien to your primary instead, so you get an owner occupied, even with a cash out hit of 3/8, because your LTV is like next to nothing. What if we did that? And they're like, oh, that makes total sense. So, or people, when they're refinancing, they think, oh, I just need what I think I need, which is I'm just going to lower my rate. Well, if they come to me, I can look at their situation and say, well, if you do it this way, you're going to save $1,500 a month. But if you do it this way, you're going to save $4,000 a month.
Yeah.
And that, Diego, is a real situation that I've had. All of this. So
I think you point out, you highlight a trend that is only going to accelerate with AI. You are a good loan originator, and you provide quality advice to your clients. There are not good LOs,
oh,
and
No, no way.
there are mediocre LOs.
yeah,
Same
amen.
thing on the real estate side, right? There
Yep.
are not
Yeah,
good real
100%.
estate agents and there are mediocre real estate agents.
Yep.
We've already been seeing a flight to quality over the past couple of years because there
Mhm.
just aren't enough transactions to go around. For
Right.
anyone that's on the bubble, if you're a part-timer or you're mediocre or bad, you're not really surviving and thriving in the housing market that we've had for the past couple of years. I think AI accelerates that flight to quality, right?
Right.
So to me, the people that are using it and incorporating it into their processes, but still providing that high touch sales approach and that quality advice,
Yeah.
those are the people who are going to win, right? So I think the winners will continue to win. And winners to me are people who are right now testing how AI can help improve their processes.
Yes, yes, yes. Yes. Amen.
Audrey, would you say that a lot of our loan conditions right now are being generated by AI? So when you submit a loan and you get this list of conditions from the underwriter, I'm guessing there's a good chunk of them that are AI generated because they don't always quite make sense.
Well, if you mean that DU is spitting out a condition, yes,
Yes.
yes, absolutely. I mean,
Yeah.
I can say that that is, for the most part,
And you spend your time reading all these similar conditions for the same thing. It's like, wait a minute, they could have said this with one condition, but no, they've 4 or 5 conditions. And when you first see it, if we were as a bad loan officer, just take the loan conditions we get from the underwriter and send them to the client saying, here's all your conditions, go get these. The clients would just shut down and say, I can't understand this stuff. It's like it's crazy. And then it's so repetitive that, like I had one the other day was 30 something conditions, and I'm just sitting there like, oh my God, my client's gonna just die if he sees this. And I was able to narrow them all down to very simple steps. Here's what I need for this, here's what I need for this. And it was 11 steps. Just get me these, 8 documents, get me, these 3 letters, get me, I need to understand this and this and this. And then boom, he was able to get it to me really quickly, get it to the underwriter, close the loan, and simple. But if I had just taken all the conditions that I had gotten from the underwriter and sent it to him, the deal was done. He
yeah,
was not going forward.
yeah, 100%. They're overwhelmed as it is, and especially because the process includes the disclosures, which are click, 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 click. No one has any idea what the hell they just signed. They don't know what they're agreeing to. They don't know what they're acknowledging. So as a lender, I believe that our obligation is to be available and encourage your clients to go through them with you, or at least talk about what they say and which ones to focus on. I mean, even when I go to my signings, they see that big stack of papers and they about fall over. And I'm like, listen, I've told you 3 of those documents matter. Estimated closing statement, note, deed of trust. That's it. The rest of it is it's information you've already seen, and it's someone covering their tail. Otherwise, those are the terms of your loan. That's what you need to walk away from. And the fact that I'm sitting there, you should see their faces. They're like, oh, right. And they just relax.
Yeah, I mean, let's think about our own experiences making really big purchases or doing really big sales. And quality advice does give you relief, right?
Mm-hmm.
In a
Yep.
very intense, anxiety-provoking process, right?
Yep.
Like what's the average home price now? Over $400,000, right? That's a huge asset purchase for almost everybody, right?
Yep.
99.9% of the country. It requires a lot of emotional investment and obviously financial investment. And wow, it's just really nice to have good advisors during processes like that.
And
Absolutely.
that is 100% the name of the game. And this is why I invite an exodus of ding dongs out of our business as fast as possible.
Is that a scientific term?
It
Ding dong?
is
Yeah.
definitely, yeah.
It's probably way over your head. You've only attended Harvard and Columbia. So if only you had gone to a real university, maybe you would have understood what I just said. So the it can't happen fast enough for me. I'm like, realtors and mortgage people, get out. If you're not doing this full time and it's not a profession for you, get out. Seriously. Like,
Yeah.
come as
As a footnote to what I said before about flight to quality, I
Yep,
think it's a great thing.
me too.
Great thing.
Okay, speaking of which, kids, if you want to keep doing loans in 2026, you might want to renew your NMLS. We've been preaching this for, let's go with months and months and months. If you don't have your CE done by now, you need to get on it. You're running out of time. And NMLS gets busier and busier as the date gets closer and closer. Remember that they have changed their website this year. I went on there, I figured out I needed a new background check and fingerprints, and I couldn't navigate that website because it didn't look at all the same. I called, they're wonderful. I always joke that they're drugged because there's no way I could take stupid questions like mine all day on a phone without killing myself. So anyway, they're awesome.
And I will echo that. I called them also, and they were just really good.
Yeah, they're so good. So call them, make sure you don't get caught, without your license on January 1st.
But don't call them on December 31st because I highly doubt they'll be.
Don't even try. Greg just said that the new website is a train wreck. I will agree it is a train wreck.
That's
Oh, no, no,
unfortunate.
no. If you had
What?
watched their video that came out, it was an hour and 20 minutes. You would have learned how to navigate their website and save 5 minutes a year.
Oh, that's what that website
Yes. They came out
oh,
a website, it was 20 minutes long and talked about how to navigate this thing so you
an
could
hour.
save 5 minutes every year renewing your license. I'm like, the math doesn't work out here.
No, I'd rather just call them. They're awesome. Do that. Oh my God, the comments are hilarious. Someone else said they called. Someone said, "Oh, baby Jesus."
So much engagement on the NMLS website.
I
Oh
know.
yeah.
Well, it's a thing,
It's a
Diego.
love-hate thing.
It's definitely a thing. Okay, I thought this was interesting. Mortgage fraud, according to Cotality, it fell for the second quarter, 2.7%, but it's up 8.2% year over year. And they're saying that 1 out of 118 mortgage applications have fraud. I mean, that seems like a lot to me. I mean, that seems like a lot, doesn't it?
You
And
know, that is a lot.
it
It's
is. It's really interesting because he is um this guy from Cotality, he is saying that he thinks it's because of some of the non-QM products, but on non-QM products, we're not using income on the DSCRs, which he was talking about specifically. So it's anyway, just
Does it write about what qualifies as fraud? Is it like knowingly withholding information, submitting
okay,
false information, or all of the above?
I would think that they are talking about material facts, but your question actually is something that I feel like we should talk about a little bit. We've talked about it recently. We've had Bob Simpson, who is a fraud expert on. He's a great guy.
Bob's awesome.
What?
Bob is awesome.
I know, I
yeah.
love him.
Yeah, and some of it is suspected fraud, not real fraud. It just so that could be raising it also.
Well, he really pointed out that it requires intent. And so even going back to the Lisa Cook situation, which we were told early on from very, very, very high, supposedly informed sources that, it was pretty clear that that had happened. And now we're finding out it doesn't sound like she committed fraud at all from what I'm reading and seeing, etc. So, apologies to her for not remembering to wait and wait and wait until we actually see facts instead of, a bunch of maybes.
Yeah, the reason I asked about that is, and getting back to AI not replacing humans, some of the fraud detection that is happening these days, it is driven by AI. That does not have a human in the loop, right? And so it's looking for discrepancies. And to your point, you do have to prove intent to prove fraud. And so I think you kind of need a human to get in there. If the AI flags something that is a
Right.
discrepancy or a potential issue, then I think that's where the human needs to take over and actually determine whether there's actual fraud or whether it was just like
Is that just a red flag?
just like forgot to submit something
Yeah.
or whatever the issue was. And I actually don't know what the specific issue in the Lisa Cook case is, but I think that particular situation was flagged using some AI technology, and now we're kind of discovering that maybe it actually wasn't fraud.
So anyone who hasn't read a deed of trust recently, um, should note in deed of trust, they outline the terms and on an owner occupied property, it will remind you that it says that your intent is that you're going to owner occupy the property for the next 12 months. That's what it says in a conventional Fannie Freddie loan. So, and then conversely, if you're doing non-QM, then those, if you're doing some sort of investment property like DSCR or business purpose at all, then it is very clearly stating you will never, and I mean never, not you, your relatives,
Yeah.
housekeeper that you call your sister, none of those people can ever live in that property because it's a business purpose loan and rents are being used to qualify. And therefore, if there are no rents, then there is no basis for it being business purpose. So read the documents that your clients are receiving and clicking on to make sure you understand what your borrowers are signing and agreeing to, and make sure that you're advising them. That's why, again, this whole conversation about, oh, just click, 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 oh, everything, just fill out. If you're, I heard this guy who everyone knows in the industry say, well, if you are taking an application with your client, you're wasting time. A computer and the it's through that conversation that you can find out. So you're going to do an investment loan. This DSCR might work for you, but then, what is your intent for this property forever?
Hmm.
Because you can't ever live there. You need to have that conversation somehow, right? And sometimes it's through the process of collecting information that these things can come up, but whether or not they're doing everything online or not, that has to be on your checklist of things to cover. And apparently, there was no intent from what I read most recently about her case. And she had, anyway, long story, but she didn't have the intent. She didn't tell them that she was going to do one thing or another. It may have started off as one thing and ended up as another, but that happens with our clients all the time because life changes.
Yeah, I mean, the situation here is it's tricky because it doesn't appear that the flag was followed up on by a human who could like discern intent and discern if this was actually a fraudulent situation. And we don't know if we didn't get a human in the loop there because of politics, because it was interesting that the three referrals that were made, were all sort of politically opposed to the current administration, right?
Yeah.
And so it's just we got to be careful with this stuff.
Yeah.
And people are innocent until proven guilty. And so in this situation, it feels like a lot of the industry kind of gave a guilty verdict before we learned what was actually going on.
That's right. Yeah. And again, we know better and shame on us because we have seen this time and time again over the last few years with headlines that splash across the, you know, country. And then
Well,
here you find out, okay, that was
that
wrong,
wouldn't work. Yeah, being tried in the press. It's like, you're automatically guilty before you actually did anything.
which is devastating to people. I mean, never mind that in general it's bad. That person, what they go through, whether it's an appraiser who's being accused of discrimination when they didn't, or if it, or you know what I mean? Like,
Well,
anyway,
it's a financial burden and it's also a reputational burden because
reputational. You can't.
uh, to win back that reputation, even if the accusation was completely false, it's
Yes,
really hard to get back to 100%
yes,
in
it
terms
is.
of your reputation. And so it's a tough situation,
It is. I
and
feel for
was
her.
definitely concerning. It was definitely concerning when it was underway.
Yeah, we have to be on high alert and be careful about making any sort of judgment or have any opinion before we get all the facts. Noted. we're usually pretty good about that. And yeah, anyway, I got some bad information and thought that it was true. So
Well, we still don't know the outcome. She could in fact be guilty, right?
Yeah.
And so we'll see.
yeah,
But it is like if she is innocent, it is unfortunate because that reputational burden is hard to overcome.
I know, I know. Okay, in other
So
news,
wait. So you're saying she won't be Fed governor anytime soon?
I think that's safe to say regardless. So with or without this situation, I think that was not happening. Um, okay,
You mean
so
Fed chair? You mean Fed chair?
chair.
Yeah, Fed chair. Yeah,
There you go. That's
yeah,
it.
that's what I meant.
It's what
Yes,
he meant,
she
not
is
what
Fed
he
governor already.
necessarily said.
Correct.
It's what he meant to say. Come on.
Yeah.
Okay, so we had a situation recently where Fannie Mae shared information about their pricing with Freddie Mac, which apparently is a no-no. And everyone who objected to this happening is now fired. And so the concern was they would be accused of collaborating or
Collusion.
collusion, yeah. And so it'll
When
be
I first heard that, I was like, same thing. Wait. I know they're two government agencies and they work together under one other agency, but yeah, wait a minute, they should not be doing that. That was my very first reaction when I heard that. And then to hear that they fired everybody who said, wait, no, they shouldn't be doing this. But at the
Well,
same time, there is some cooperation that needs to go between the two because they, in some ways, work together. So it's a fine line. Go ahead, Diego.
Well, I'm just thinking that it really depends on what's going to happen with the GSEs, right? So there's been talk of merging them into one company and taking that company public. The Great American Mortgage Corporation, I think was the working name. And so that if that's an option, who cares if they're talking, right? Because they're
Right.
going to end up the same company anyway. But it does seem like a lot of the industry is rooting for them to remain separate companies, right? Whether they go public as separate companies or not is a whole other discussion and debate that I think is happening. But if we do want them to be competitive, whether they're under conservatorship or not, they probably shouldn't be communicating like this. They probably need to have an arm's length relationship.
Right.
I just think of the Optimal Blue website or lawsuit going on right now, where these companies, I mean, two of whom hate each other's guts, and it's hard to imagine them colluding on anything, are accused of price fixing and all in collusion, etc. So yeah, I mean, I think that you
Well,
really have to avoid any. I
in the real estate side, there's also now talk of collusion between Redfin and Zillow. Um,
Yeah,
so and that's a whole other
so
piece. I mean,
much. There's
yeah.
so much.
There's a lot going on, as we talked about at the beginning,
What's going on? All right,
beginning
let's
of our
keep it
conversation.
moving. Speaking of a lot going on, let's talk portable mortgages for a moment. This is an idea that is being floated as an option for making it easier for someone to take their 3% mortgage or rate with them when they go to buy a new house. Diego, what's your opinion on this?
Um, I don't have much of an opinion on it, only because uh, from all that I've read and all that I understand, it's a fairly far-fetched idea that will require a lot of changes to our current ecosystem, some of which are legislative changes, and I just don't see any of these changes happening in the current polarized environment. Nothing is going through Congress. We just had our government shut down for 43 or 45 days. And so, to me, like it's all about working on things that are tangible and that you can actually make happen. And so I think that there are a lot of ideas out there that have a much better shot at actually happening. I mean, if you look at something like fixing the LLPAs or lowering the G fees, those are things that can happen really without congressional approval, right? So the administration could just do it. If you want to address affordability and fix some of the broken issues in housing and in housing finance. And I think there are other things like that would have a much bigger and clear-cut impact and more tangible, right, and more achievable impact on affordability than portable mortgages or like the 50-year mortgage, which again, it's not, it would just require a significant adjustment and changes in our housing finance system to make it a reality. Not even considering whether it's actually a beneficial product for home buyers, but it just would require so much work across the aisle and within our housing finance system that it just doesn't seem achievable.
And even if it was achievable, the ROI, I mean, last week I gave an example of a 30, a 40, and a 50 year just on amortization. If you're just using the same interest rate, which we know there is a big difference between the rate on a 30-year fix and a 40-year fix, and presumably from 40 to
A
50
50.
would be a similar, if not even more bigger rate, because the risk involved is greater for the investors, right? And they're tying up their money for, forever. It is something that is, yeah, it's a lot. The
Yeah, I
portability.
mean, you
Go
really
ahead.
wonder. You have to question whether a 50-year mortgage is actually better than just renting, right? And if you're going to have a down payment, put that down payment into other assets, like equities or bonds, and just keep renting. Because the problem with the 50-year mortgage, especially because it will have a higher interest rate because it's a longer term, is you just don't build any equity, right? It takes decades before you're building any equity, and so it's not, it just doesn't seem like to be a tangible deal for most home buyers. And then, what I've read about portable mortgages, so if we set aside that it's not very realistic, it probably doesn't, they probably don't address our big issue, which is affordability, right? Because a portable mortgage is only good for somebody that already has a mortgage, right? Is already in a house. And so it doesn't really address first-time home buyers, which I think we all want to address if we're going to do anything related to affordability.
Yeah, the
I
50-year mortgage issue, um, when I was thinking about it, it can make sense in some very specific areas, New York City, San Francisco, where there's rapid appreciation in homes. And so for a lot of people, it's just get in the door and get in the house and then let the house appreciate. And that's where you gain your equity. But in the vast majority of the US economy, the way people get their equity is by paying down the mortgage. In Oklahoma, home values haven't changed that dramatically, over the last 10 years or so. And they have a little bit recently, but if you take out COVID, prior to that, the home values didn't go up too much in most of the middle of this country. And the only way you gain equity is by paying down your mortgage. So therefore the 50-year doesn't work. Now in like the Bay Area, we had a product for a little while. It was called it was a 40-year mortgage, it was 10 years interest only, and then 30-year fixed after that. And that made sense for some people to get themselves in the door, keep their payments low, and they gained equity by their homes values jumping up. But if home values aren't jumping up, a 50-year loan doesn't make sense.
Okay, so I can think of 500 other ways approximately to get someone into a property and have it make sense versus
Mhm.
putting them in a 50-year mortgage. And yes, a lot of people have said, oh, they'll just refinance later. And my counter to that is you can't count on that. You don't know. Are you going to have your job? Are you going to have lower rates? Are you going to, I mean, how many is your value going to be what it needs to be? There are a lot of variables around counting on a refinance later. To Kevin's point, I 100% agree on the equity situation and the fact that, when people say, oh, well, why don't you just rent forever? It's fine. Oh my God, I was listening to a really old Freakonomics episode the other day, and it was this guy who was promoting the idea of why doesn't the government just build a whole lot of high density housing? Meanwhile, he and his family just moved to the freaking suburbs and bought a house. And I'm like, that is such bullshit, because then you're just locked into your little tiny, place where you live. And what if you want more? I mean, yeah, I don't know. Anyway, it is, do we give him credit for having ideas, Diego?
I don't really No, I mean, for me, ideas are a dime a dozen, right? Like it's all about execution and something being realistic and tangible.
Yeah.
And so like there's tons of like great ideas out there, much better ideas than I think these two ideas. And so no, I don't give a lot of credit for just having an idea, especially if it's not realistic.
I'm trying to be nice here. I listened to a couple heads of company the other day give a talk, and I'm like, I emailed someone, I said they really should be listening to our show because if they did, they'd have more information and they would like sound smarter.
You
It
know,
was,
what what I can say about these two ideas is I love the industry response to these two ideas. It was pretty overwhelmingly like, hey, we've got lots of ideas over here that could actually work. Why don't you come talk to us,
yeah,
right? Like we're actually, we're the boots
Industry.
on the ground,
Yep.
executing on all this stuff. Come talk to us. And so, to me, I hope that is the takeaway at FHFA. Hey, maybe we need to get some industry roundtables together and get some really good feedback.
yeah,
There are people in the industry who not only have really good ideas, they're ideas that can be executed on right away, right? So
yeah.
let's go get those ideas and let's get people into position to execute on those ideas.
I thought the
Like that.
NAHB housing market index was interesting this morning, builder confidence. So it is negative for the 19th straight month. It went from 37 to 38, which is an incrementally tiny increase for the better. Anything under 50 is not good. So the builders are not feeling confident. And I think part of the problem is the messaging that people are getting with these crappy headlines. Back to our comments about the, 20% rise in foreclosures. And that makes everyone think that, oh my God, there's going to be a deal if I just wait, right? But the other thing too that we don't talk about a whole lot is that a lot of the people who would be first-time home buyers and we're now at an average age of 40, their parents lost their houses in foreclosure during the meltdown. That's what is not the topic. And I think there needs to be some major push to address this nationally so that people who went through that with their parents, that is, sorry, it's trauma. Their whole family lost everything and they associate that with housing. How do we fix that? Because housing and owning a house under normal circumstances is security. It's not a risky, horrible thing. And now that we have the ATR and we have all these checks and balances in place, it is a very different situation than it was pre meltdown. So what are your thoughts on that, Diego?
Yeah, I do have some thoughts on this topic. HousingWare actually just recently acquired a publication called The Builder's Daily, which
Yeah.
is a publication for home building executives. And we just hosted our first in-person event since acquiring that brand for home builders called Focus on Excellence. And this was 100 home building executives, very senior executives, in a room for 2.5 days, just walking through what's going on right now in home building. It is a tough stretch right now because one, mortgage rates are still uncomfortably high for them, and it gets, the higher the mortgage rate, the more they have to shell out if they want to buy down those rates, which has been a big part of what has made home builders successful over the past couple of years of kind of a dismal housing market. The home builders have been a bright point, but that's because they've been able to buy down those mortgage rates and basically cut into their margin to do that. So if we stay above 6, or in the mid 6s, it's just the math is tough to buy down those mortgage rates. So that's one issue. Two, they're probably the vertical in housing that is hit the hardest by tariffs.
Yeah.
Hit really hard. Like it's bad.
Yes.
And I was talking to several of these executives, And they're not public about it, because I think if sometimes if you're public about this as a public company, you can get punished, by this administration. But it is a challenging thing from a cost perspective, dealing with tariffs that disproportionately impact your ability to build a home. A lot of what goes into a home is imported, right? And then there's a third variable, which is immigration restrictions have an outsized impact on the home builders, because a lot of the folks that build homes, um, are you maybe don't have the status that they need to have to be working legally in this country.
I would
Um,
echo that one. That's huge.
it's a big deal, and again,
Yeah.
it's something that these folks will talk about in private rooms, but maybe don't talk about in public so much. And so that's three really significant headwinds that are making it harder and harder for an affordable new home to be built. It just
Yep.
doesn't pencil out. And so all of them, for the most part, are building, higher end homes, with higher starting price points. And again, that just doesn't address the affordability issue that I think we're all kind of grappling with right now. And so I don't blame them for being for being pessimistic.
Right.
They've got a lot of headwinds that they're dealing with, and I don't really know how any of those scenarios change. Probably mortgage rates first, right? It does seem like we are seeing more job cuts and labor softening more quickly in the second half of this year. And so inevitably that will lead to the Fed lowering, even if inflation stays warm. They're not going to let the labor market completely break. So maybe that has an impact on them being more confident, but they're struggling with some pretty significant headwinds right now.
There's a couple of things. So first of all, there was a whole parade of Fed speakers last week, and a lot of them think that the labor market is just fine.
Yeah.
I'm just fine. So they're a little out of touch from what I'm
We're only creating 2,500 jobs a week, according to
the week before
ADP.
was 11,250 jobs. That was what he's referencing.
No, that was for the month. I'm saying
No,
2,500 a week.
No, it's per week.
Really?
So what he's talking about is ADP has now started publishing a weekly report. And so this last jobs report or last report and it's brand new. So when I say last, I think they've done what, two? So the one they just did was the week ending November 1st. So that showed 2,500 jobs lost per week. The previous 4 weeks, it was 11,250 losses per week. So that's ADP. So that's just private. That doesn't include any government jobs. It doesn't take into effect, anyone who doesn't use ADP for their payroll, like my understanding is Amazon doesn't, like some of these huge companies that aren't using ADP, but it does definitely indicate that we've got some issues in the job market. I don't think so. Again, Thursday's BLS report will be interesting. Also, the Fed has been very clear that if they don't have the data at the next meeting, they're not going to lower. And also, by the way, how many
and by the way, they're probably not going to have the data. Let's be realistic. The government was closed for, I think, 45 days, I think, or 43 days. There was key data that needed to be collected during those 43 days that would have contributed to them being able to make a better judgment call at the December meeting. I just don't think they're going to have very good data. The September data, it'll be interesting to know what was happening back in August. But it doesn't really help the Fed deal with late December, right? I'm not sure they're going to have really good data until the meeting after this one.
Well, there's a couple things. First of all of those government employees that were furloughed and then they had until September to make a decision on whether or not they were going to keep their jobs, leave, whatever. That all ended in September, right around the time all this was hitting the fan. And just out of sheer coincidence, I happen to have from BLS their estimates on when those reports might be released. So on that note, CPI, it looks like we will have all of that handled. October's probably canceled. And then we should have November CPI, December 10th, maybe but it might be a little late. That one might be a week after, then they wouldn't have CPI. For non-farm payrolls, they're going to have October probably, but the November non-farm payrolls probably won't happen before the Fed meeting. PCE, and PPI, it looks like maybe early December, but we'll see. But again, here's the thing, Diego, every time the Fed lowers, the mortgage rates don't go down necessarily. So
Yeah, I actually think that I know there are a lot of opinions about Jerome Powell, but the way that he describes the current situation, which is kind of trying to make driving decisions while going through very very, very thick fog,
yeah,
is very accurate. And I have some understanding and empathy for the position they're in, because not only are they driving through a fog from a data perspective, but if you think about what's been happening in the economy, where job growth has been deteriorating at the same time that inflation has been warming up, right? So that is, we're heading in a stagflationary direction, at least according to the last data that we got back in August and September. A stagflationary economy is just, it's almost impossible for the Fed to navigate, right? Because if you think about it, if you raise rates to deal with inflation, you are increasing unemployment.
Yep.
But if you lower rates to help with unemployment, you're increasing inflation, right? So it's a really difficult catch-22, all while you don't have all the data that you usually have to make the call. So I can understand why there is a lot of really dispute happening on the FOMC right now. I think it's split pretty evenly, and it'll be really interesting to see the notes, because is it like 8.4 8.4 for lower rates, or is it the opposite, right? Are there more is it more hot, is it majority hawkish? I think the Fed notes will give us a sense of that, and so that'll better enable us to make a call about December, because if the majority is hawkish, it's going to be really hard for them to make a decision to cut rates. I don't think that they would ever raise, but they would probably just leave it neutral, right? Leave it flat. And even if the majority is dovish, it depends on how like adamant and pounding the table the hawkish members are, right? Because there are pretty clear signals that inflation has been warming in the second half of the year, right? And so they just have to deal with this catch-22 in a fog.
Yeah. Well, I think that although we haven't had the government data, we have had enough other data that really gives us an idea of, so for instance, the WARN notices from companies that have more than 100 employees, those are up a lot. I mean, a lot. It's the most since 2009 if you remove COVID. So companies are indicating, hey, we've got a problem. We're not hiring, or we are going to do layoffs. I mean, there is a lot of information out there about that. And again, there's 6 weeks typically between Fed meetings. So what they said at the last Fed meeting is very interesting, but we've had quite an eventful 6 weeks by the time we get to the next one. So to your point, I think it'll be interesting to see what they were thinking then. I think it is very dependent on where the information leads us. And again, it's only November, whatever, I don't know what date it is, but whatever date it is, December 10th is the next meeting. That's weeks away. And as we've seen a million times, anything can happen in between then and now and then, right?
Yep.
So
Totally agree. It's we got 6 weeks, no, 5 weeks until this meeting. Plenty of time for things to go in either direction.
it could get better, could be worse. Okay, I just wanted to rip through rip through. That's such a great way to put it. Some of the ICE data that came out. So national delinquency rates, because again, these are things like if there's some funky headline out there, it's important for us to know as LOs what is real. So according to ICE, which is a very credible data source and for our industry, national delinquencies are better in all categories except for FHA. It is so FHA is 47% of delinquencies and 52% of severe delinquencies. That's crazy. And they're only 15% of all mortgages. So FHA is experiencing issues for sure. And then remember that when we are talking about VA had a foreclosure moratorium up until a few months ago. So they're coming out of that. They're working through some of those loans, et cetera. So that's driving their foreclosure rates up a little bit. But conventional and non-QM are performing. So, and we are
That's good.
22% below per ICE for the third quarter, 22% below pre-pandemic levels, even though we are up year over year. So,
I mean, that to me is the key stat, right? Like, it is concerning for sure, and that FHA
yes,
are going up, right? And sometimes that can be the canary in the coal mine. But I think we should be reassured by how all of the rates are delinquency rates, I believe, including FHA, are still below historical norms, right? And so, for the most part, the U.S. homeowner is in great shape. We have almost historical highs in terms of nested equity. And there's like very few people that are underwater on their mortgages, and that's where you start to see people, just give back the keys because, why pay?
Yep.
And so I just don't, this doesn't, I think that, if you look at the kind of housing market doomers, you probably talked about this a lot with Logan. They're probably spinning up about this data. And, I think it's worth having some caution and observing what's going on, because we do seem to be heading into a trickier economy that isn't great for the majority of people. And so that could have an impact on increasing delinquencies. But right now we seem to be in like pretty good shape when it comes to
NAR's coming out
when
with
it comes to equity.
it was
Yeah, no-
interesting because Florida, Louisiana, and Texas are the worst states, and California and Arizona, weirdly, are the best.
Huh.
I thought that was something.
Well, you saw that NAR is coming out today with the 4% projected appreciation.
Yeah,
for
we're gonna get there.
2026.
Hang on, let me just get
Well,
through
you
this.
only got 4
I
more
got-
minutes.
I know. I'm gonna fast. Okay.
There's so much to cover, Kevin. We just
So
can't get
much.
to it all.
I know, because we're in a normal market, which is crazy. Okay, so interest rates. So 6 1/8 is expected for spring. And they were saying that the number of highly qualified refi candidates in late October was the highest in 3.5 years at 1.7 million. 1.3 million with rates in the high sixes right now. That's a lot. And if we were at 6%, 5.5 million refis are possible. And I just want to push back for 1 second because I don't think 6% is a bad rate. I don't think we should be dreaming of something much lower than that. I mean, high fives, mid fives would be great, but that is not going to make all the difference. Insurance costs, that's going to make a difference. I mean, maybe if they
Huge.
really wanted to increase affordability, they could work on, I don't know, property taxes. And to your point, LLPAs, G fees, all of those things that are driving rates that they're so fixated on because they don't have to say, oh, we're going to lower our profits. Fannie, Freddie, quarter after quarter, $1 billion income, what is the word I'm looking for God's sake? My brain just went blank. Anyway, profits, that's it.
Yeah.
Okay, listings still 16% lower than pre-pandemic, and 40% of markets are seeing an inventory pullback. So that's something. Affordability is the best in 2.5 years. That's something, right?
Yeah.
Okay, I thought this was interesting too. So single families, their values are up slightly, but condos are down in 95% of the markets that ICE keeps data on, which is nuts. And here we go with equity levels. Growth is slowed, but volume remains at record highs. 47 million mortgage holders, 14.7 trillion in mortgage debt, 17.3 trillion in equity. The average CLTV is 46%.
That stat is incredible.
It's
Just
incredible.
think about that. Like,
Yeah.
that is so much equity.
Mhm.
Below 50% loan to value. I mean, wow. We
Yes.
should be really
That's
celebrating
backwards.
that.
We
That's
should be
incredible.
celebrating that 100%. $17.3 trillion in equity. That's incredible. So here's where it gets tricky to what we were saying before. If you purchased in 23 or 24, a third of them are underwater in pockets of the country. 1 in 20 loans originated in 2024 are negative. So those are the loans you got to watch. Those are the people that you got to be looking out for. So when the rates come down, can you do, like if they've got an FHA loan, can they just do a rate and term refi or a VA refi where you don't have to worry so much about the value? You can just lower their payments. So what can we do to help? Is there insurance? Has the insurance rate, could it be better than it is right now? Because again, they keep pounding the beat about affordability with housing. And I'm like, what about how expensive cars are? How about how expensive the car payments are and credit card debt and childcare expense, for God's sake? You know, I can't decide whether I'd rather have kids in college or in daycare because they're both really bloody expensive.
It's so true. And I think the electorate really had a chance to register their opinion on affordability a couple weeks ago. Now, off your election, in pretty safe Democratic areas, New Jersey, Virginia. Well, I guess Virginia is not super safe. A little bit more purple, and then New York City obviously is pretty blue. But if you look at how much of the vote shifted from Trump support to support for the Democrat in those elections, I think that rang some alarm bells in the Trump administration that we do have an affordability problem. And it's not just homes. To your point, Audery, everything is too expensive, right?
Yep.
And so, I've actually been encouraged that since that election, the Trump administration has been rolling back some of the tariffs, especially the ones related to foods, because grocery prices are just ridiculous. And I'm encouraged and hopeful that they will keep their eye on affordability, because if they don't, they're just going to get shellacked in a year in the midterm elections. It's going to be ugly for them. So yeah, I'm encouraged that Trump seems like somebody who reads the papers and has an intuitive understanding of the electorate. And the electorate clearly said some things in this last election about affordability.
Yep.
Though I saw a Washington Post poll that said that although the vast majority of people didn't agree with what he was doing, they were not, it did not increase their support of the Democrats necessarily. It was, we don't like what you're doing, and the only other alternative is this other thing. And so it's really dicey
Yeah.
out there, I think. I'm like, everyone needs to get it together and do better on every side. Okay, so Kevin wanted to briefly talk about loan limits increasing. Kevin's excited. I'm so indifferent. I don't even think it's worth talking about. But I want Kevin, tell us your opinion about why this matters. Tell us.
All right, so loan limits, the official loan limits should be coming out in the next few days here, either right before Thanksgiving, right after. I don't remember the exact date. And once that number comes out, that number is the official loan limits. We had some temporary ones came out by a few companies. I think it was 819, if my memory serves me right. But when the real number comes out, that will also affect units for 2, 3, 4 unit buildings. So those numbers come out and those are official. So just if you've got a deal that's right on the cusp, you may not want to lock this week. You want to wait out for a couple days to see those numbers come out with the real conforming limits come out, especially if you're looking at a 2-unit building, 3-unit building, 4-unit buildings.
For me, the annual loan limit thing it's always fun to see whether it's going to be Rocket or UWM
Comes out first.
that raises first, that kind of
Yeah.
preempts the official loan limit. And I think actually this year it was neither of them. I think Penny Mac might have jumped
To the
it.
punch, yeah.
But I'll have to go back and look. It's just fun every year to see who wants to jump it the most.
You know, when
Yeah.
when we started doing this show, we had this thing called the crystal ball competition where people would guess what they thought the new loan limit would be, and for extra credit or a tiebreaker, it was what day would it come out. And this has ruined all of that for all of us. And we are so late that now we have to talk about NAR's forecast next week. So, Diego, the sign of a good show is it goes super fast and you run out of time before you run out of things to talk about. And that is certainly the case today. So thank
Well,
you so much.
I love talking with both of you. Happy to do it anytime. Thank you for asking me back on your show.
We really
Oh, you're
appreciate
welcome
it,
anytime.
and we'll look forward to seeing what Housing Wire comes up with next. You also just want to briefly mention that you have some gatherings happening, including one that's called
Yeah,
the
we have some live events. We actually talked a lot about housing economic data in this conversation. We actually have our Housing Economic Summit on February 10th, and you can find out more information about Housing Wire's Housing Economic Summit by going to housingwire.com.
Great.
Nice.
All right, with that, guys, there are loans out there. Do not take the rest of the year off. That is ridiculous. So
Hey, are we taking next week off?
What?
Just
No,
want to
we're not.
remind, we're
Kevin,
not taking next week
course,
off. We will be here next
Slacker.
week, the
Oh, no,
day
we're not
before
taking.
Thanksgiving.
We'll be here next week. You should be here next week too. We're going to keep working and closing loans and helping people get into housing so that they have a
So that they can have Thanksgiving at their house next year.
right. All right, kids. Have a great week. Mwah.